This is Michael King. Today we're going to learn how to build a pro forma financial forecast. Financial managers will use pro forma forecasts to anticipate their cash flow needs as well as their borrowing needs. They generate forecasts of both the income statement and the balance sheet, and in this next exercise we're going to look at how to do that for Apple Inc. We're going to look at how much cash is used and generated by the business and whether Apple needs to raise external financing. Let's take a look at the cycle. We start by setting our key assumptions for sales and the different margins for the income statement, as well as key relationships from financial ratios for the balance sheet. We then generate our income statement starting with sales and generating most items as a percentage of sales. One item cannot be calculated is the interest expense. In order to calculate interest expense, we have to forecast our debt schedule. Once we know the debt schedule, we can calculate the interest expense and complete the income statement. Next, we calculate working capital schedule using days of inventory, days of accounts receivable, and days of payable, and setting the other working capital items as a percentage of sales. Once we have the working capital schedule and the debt schedule, we can complete the balance sheet. We then are able to generate the statement of cash flows, which ties together these different financial statements. Notice that when we generate the statement of cash flows, we're able to predict the change in cash, which is not available for the balance sheet. The balance sheet does not balance until we enter a plug, which is going to be the amount of cash that was required. Lastly, we calculate the financial ratios based on our forecast, see if they make sense, and check the sensitivity to the assumptions. Deciding the key assumptions is the first step. We need to know sales growth and margins, the cost of debt and quantity of debt, the individual working capital accounts, as well as other current assets and liabilities, the tax rate and dividend payout ratio which will be used to generate retained earnings, and the amount of depreciation and capex. The easiest way to calculate these ratios in your forecast is to use historical ratios over the past 3 to 5 years. However, if you see a strong trend, you can use the most recent value, or you can forecast a value based on the trend. Common size financial statements are a useful way for identifying these trends and averages. So here are the key assumptions. You'll need to forecast sales growth either using a management forecast or your own assumption. COGS and SG&A will be set as a percentage of sales. Depreciation will be set either as a percentage of assets or as a percentage of sales. Interest expense is simply going to be the interest rate that you'll be assuming times the total amount of debt outstanding. You can look at taxes based on some assumed rate, either the marginal rate or the effective rate from the previous year times pre-tax income. You would determine dividends based on the payout ratio times net income, and this would allow you to calculate how much of net income is retained earnings, which will then increase equity on the balance sheet. Let's take a look at Apple. Using these 3 years of financial statements from 2016 to 2018, we have the levels of the values, which are not particularly helpful. What is helpful is to convert them into common size financial statements, where income statement items are expressed as a percentage of sales in each year, and balance sheet items are expressed also as a percentage of sales. We are going to set COGS, R&D, SG&A to their 2018 values when forecasting 2019, 2020, and 2021. And similarly, we're going to use historical relationships when making our 3-year forecast. We're able to use this forecast to generate sales, COGS, R&D, SG&A, and we can calculate our operating income or EBIT. However, we cannot calculate the remainder of this income statement until we know what our interest expense is. How do we forecast this income and interest expense? Well, we need to know the quantity of debt and the average cost of debt. We start by assuming no change in the quantity of debt outstanding. On this basis, interest expense in the next year will be the same as it was in the past year. Notice, however, that if we were going to increase the quantity of debt, interest expense would increase. That would lead to a lower net income, and it may lead to a decline in cash, which would require higher debt in the future. There is therefore a circularity in your forecast, where debt, interest expense, and cash are all related. Quantity of debt determines interest expense determines cash balance determines how much quantity of debt is required in order to avoid bankruptcy. So let's look at Apple's debt in 2018, where the average cost was 2.8%. This was calculated by looking at the interest expense that was actually paid over the debt outstanding. If we assume that both of these are unchanged, we can forecast the interest expense in the coming year. Notice that the interest expense is going to be $3.2 billion in 2019, which is the same value as in 2018. If we assume the Apple tax rate is 21%, which is the new rate that was announced under the Tax Cut and Jobs Act, you can calculate the net income for those remaining years. Next, we forecast working capital. Notice that we calculate the ratios of days of receivables, inventory, and payables using these formula for the past years. And we're going to assume that for the coming 3 years, the ratios remain unchanged from 2018. Once we know sales and cost of goods sold, we can use these formula and these assumptions to calculate those working capital numbers. Okay, with debt and working capital, we can now forecast most of the balance sheet. The only item that we won't be able to forecast is cash, which we're going to leave empty. We're going to be using cash as a plug to balance the balance sheet later. We're going to look at CapEx and depreciation to determine PP&E, where the relationship is based on this T account relationship, where we start with beginning property, plant, and equipment. We add CapEx in 1 year and subtract depreciation that year to find the ending property, plant, and equipment. We can calculate other assets and other liabilities as a percentage of sales. And we therefore can get shareholders' equity based on the accounting relationship, where any net income that is not paid out as dividends, is retained earnings, is added to the starting value of equity. We assume no equity issuance and no share repurchases. This allows us to get our common equity on the balance sheet at the end of the full year. Notice that we have here Apple's balance sheet from 2016 through 18, which are actual values, and our forecast from 2019 through 2021. Cash, which is both cash and equivalents and marketable securities, is not shown because it is yet to be determined, but we are able to calculate all the liabilities and shareholders' equity. We therefore know what our total assets will be, because total assets is equal to liabilities and shareholders' equity. We could use the statement of cash flows to determine the quantity of cash available at the end of each period. Notice that we would have starting cash. We calculate cash from operations, cash from investing, and cash from financing to generate our end cash. Or we could simply use a plug, which is the value that makes the balance sheet balance. We will also assume that marketable securities remain unchanged, which is a simplification. Okay, notice that we have total assets equal to total liabilities and shareholders' equity, and we have marketable securities, which is unchanged from 2018 levels. As a result, we can back out what cash and cash equivalents must be, because this is the total that will balance the balance sheet. Notice that cash increases when the company has positive net income and is profitable, when working capital is decreasing, when long-term assets are sold, or when equity or debt are issued. Cash will decrease when the opposite happens, when the company has losses, when the company increases working capital with sales, when long-term assets are purchased, or when equity or debt are repurchased or retired. Next step, does our balance sheet balance? Assets must equal liabilities plus equity. You may get a circular cell reference error, which means that you are referring in a formula to a cell that is the result of a calculation. Here are 5 places where you may have made that error. Notice that your working capital has to be based on ratios, that interest expense or the quantity of debt has to be based on the debt schedule. You may have calculated fixed assets wrong by getting CapEx and depreciation reversed. You may have forgotten to add retained earnings to your common equity, or you may have forgotten to deduct dividends as a use of cash. These would all be reasons why your balance sheet will not balance. If you're still stuck, it's always a good idea to ask someone who's either a financial analyst or an accountant to check your formulas, because forecasting financial statements is not easy. Lastly, we want to use this pro forma forecast as a tool to understand what is going on with the business and in particular the future financing needs. So we're going to calculate the financial ratios for each of the coming 3 years. And we're going to check that they seem to be reasonable and are not either going up sharply or down to zero. We're also going to look at whether the business looks sensible. That's it. Good luck with financial forecasting.